I'd like to take a moment and explore what happens if we make an error when we're measuring our inventory. Now, recall this relationship here. And if you like to do it in equation form, that's fine. If you're a more visual learner, that's also fine. But you really need to have this equation committed to memory. Not only for this class, but this is going to bleed over into your study of managerial accounting. It's a fundamental concept. Beginning inventory plus purchases, which we can see right here, minus your ending inventory equals your cost of goods sold. Now, of course, we know beginning inventory plus purchases, that is your cost of goods available for sale that we see right here as well. That's the total, not only pool of dollars that is associated with the goods we have available for sale, but that is the measurement of the maximum amount of things that we could sell. Now, we're going to sell some of those, and those dollars and things become cost of goods sold. And some of them are going to hang around as inventory, and those things stay in inventory, and their dollars stay on the balance sheet. So keep this concept in mind. As ending inventory increases, your cost of goods sold will decrease. Let's go back to this relationship here. If you see that ending inventory goes down, well, that means that your cost of goods sold will go up. And if your ending inventory goes up, your cost of goods sold will go down. And that's exactly what you're seeing with my son and daughter at the playground right here. If we overstate our ending inventory, that's going to have the effect of making our cost of goods sold calculation lower. If we understate our ending inventory, that's going to give rise to a higher expense, a higher cost of goods sold. Let's see how this would work out with an example. So what I'm going to show you on the top here is this is what was supposed to happen for 2018 and 2019. I'm going to drop the zeros, okay? These are all in hundreds of thousands, but just to kind of keep things simple. So we were supposed to have $100,000 in beginning inventory, and that's what we really did have. And our purchases were $200,000. And our ending inventory, we counted it all. It's $50,000. So our cost of goods sold, if everything was done properly, our cost of goods sold would be measured as $250,000 for the year 2018. Now, get to 2019, guess what? Ending inventory for 2018 is your beginning inventory for 2019. So what was supposed to happen here is that beginning inventory is $50,000. It's a different year, so our purchases are different. We purchased $400,000 of inventory, and we properly measure the ending inventory at $300,000. So our cost of goods sold for this year is $150,000. That's what was supposed to happen, okay? I'm going to just kind of label this one as correct. Let's presume now that we made a mistake with our ending inventory for 2018. So, everything else is kind of accurate. So we're going to call this incorrect here. So beginning inventory, there's no problem with that. We didn't make a mistake with beginning inventory. Also did not make a mistake with our purchases. Okay, the $200,000. But now look at the ending inventory. Instead of reporting ending inventory at $50,000, we either made a clerical error in the bookkeeping process, or maybe when we counted the inventory, we made some kind of an error. But the takeaway is this. Ending inventory shows up on our balance sheet as $60,000. So it's overstated. Remember what happens when ending inventory is overstated? Cost of goods sold gets lower. And that's exactly what you're going to see here. Instead of being $250,000, what it's supposed to be, this cost of goods sold is mathematically measured as $240,000. So overstating the ending inventory for 2018 understated our cost of goods sold for 2018. All right, how is that going to play out in the next year? Let's say that's the only mistake we make. Ending inventory at the end of 2018, well, if it's undetected, if we don't catch that error, that $10,000 error is going to bleed through. It's going to flow through into the next year. Now our beginning inventory for 2019 is overstated. And pretend that everything else is just peachy keen, okay? We record the $400,000 of purchases the way they're supposed to. We don't make a mistake with ending inventory. So what's going to happen now is our cost of goods sold is going to be overstated by 10,000. So what you're seeing here is inventory errors take 2 years to correct themselves, 2 periods to correct themselves, unless they're detected and fixed, of course. So if undetected, if uncorrected, an inventory error will take 2 years to correct itself. What you can see is over the 2-year period, this is a cost of goods sold of $400,000. So over the 2-year period, we still had an aggregate $400,000 cost of goods sold, even when we had the errors. And that's true here. Over the 2-year period here, it was $400,000. But what you're seeing is this. That overstatement of ending inventory at the end of 2018 caused cost of goods sold to be lower. Ending inventory was higher on the balance sheet. With cost of goods sold lower, that means our gross profit was higher for 2018 than it should have been, and our net income. We enhanced profitability for 2018. 2019, that $10,000 error comes home to roost, and we see that not only will cost of goods sold be higher than it should have been by 10,000, we're talking about the 160 instead of the 150. That means for 2019, our gross profit will be understated and our net income will be understated. So you can see that an error in the inventory accounts can certainly impact the reported operational performance of a company.